If you're a business owner in Australia and you're not doing tax planning before the 30th of June, you're leaving money on the table. In this video, I'll show you how to figure out your current tax position and what you can do legally now to save thousands of dollars of tax. And if you're in the first year of business, you really need to watch this because there's a real kicker in here if you're not prepared. Hi, I'm Craig Anderson. I'm a husband, father of 5, accountant with 20 years of experience, and in the last 15 years, I've built and sold multiple businesses. I now help business owners start, grow, and scale businesses that don't take over their life. Before we get into this video, I want to do a quick disclaimer. While I am an accountant and a tax agent, and I've advised hundreds of clients over the years, this video should be considered general advice only. It's not specific to your circumstances. I don't know you, I don't know your business, your other family circumstances, so it's not going to be advice that's direct for you. You should be seeking out your own accountant and tax agent to help you with that. But what this video will do, it will give you the tools and information so that you can have an educated discussion with your accountant and make sure they're helping you in the right way. All right, in this video we're going to cover off a couple of things. Firstly, we're going to talk about the basics of what tax planning is. We'll help you find out what your tax position is now and what you should do about it. Then we're going to talk through some tax planning strategies and how they apply to business in general and different types of businesses. And then we're going to give you some actionable items at the end that you can start to do right now before the 30th of June to make sure that you're not paying more tax than you need to. So what is tax planning? Tax planning is identifying and implementing tax strategies to make sure that you don't pay more tax than you are legally required to pay. But before we jump into that, we need to first of all understand what our tax position is. And that's something that's often lost in tax planning. We often think about, well, how much can we try and save? But it's really important that we understand how much tax we do currently owe and will owe, which is really important for cash flow purposes. But before we jump into anything further, we really need to cover off a couple of basics that relate to the Australian tax system. Now, I'll keep this really short because I know you want to get onto the real meat of it and get into some tax planning strategies. But I just want to lay a foundation and a baseline to make sure that we're talking on the same page. Australia has, for individuals, a progressive tax system. We call them marginal rates. Now, the reason we're talking about individuals, and even though this is intended for business owners, is there's really only two structures that pay tax, and that's companies and individuals. Trusts shouldn't be paying tax. We want to avoid that. It should be distributed out to beneficiaries, and those beneficiaries are often individuals ultimately, and they will pay the tax. The same with a partnership, and while you can have a partnership of other structures, like a partnership of trust, for example, ultimately that income is going to flow down to the individual. So we need to firstly understand what the individual tax rates are and also what the company rates are. For individuals, you can see that the tax rates progress from $0 to $18,200. Then from $18,201 to $45,000 is 16%. From $45,000 to $135,000 is 30%. From $135,001 and $190,000 is 37%. And over $190,000 is 45%. Now those numbers exclude the Medicare levy, but we're just going to keep it simple like that. For companies, and most of the companies that we're going to be talking about, base rate entities, which is under 50 million turnover, is paying 25% in tax. So those are the tax rates that we're going to refer to as we go through this discussion today. And they're really important because there are tax planning opportunities because we have that progressive or marginal tax rate for individuals. That mean that the timing of income and deductions can mean that we can benefit by using those tax rates to our advantage. All right, now we're going to talk about tax position. This is what you owe and when you are going to pay it. As an individual, as an employee, your employer is the one that withholds the tax from your pay. If you're on a salary of $100,000, they'll take out the requisite amount of tax each pay period and send that to the ATO. So that when you lodge your tax return at the end of the year, if everyone's done the right thing, you should actually be in a tax neutral position and neither owe tax or have any tax refunded. But, and this is the kicker for those who are new to business, when you first start into business, there is no pay-as-you-go instalment system because the tax office doesn't know how much you're going to earn. So let's jump onto the iPad and let me show this by way of example. All right, well, let's say you started your business on the 1st of July in 2024. That could be any year. And at the end of the year, on the 30th of June 2025, you've made, let's say, $100,000 in profit. So let's assume there's $500,000 in income, $400,000 in expenses, so you've made $100,000 in profit. Now, there's going to be tax payable on that, and let's call it, let's just for argument's sake, let's say it's $20,000 in tax on that income. Now, the ATO doesn't know at the end of that financial year or this coming financial year, if you started this year, they don't know how much money you've made. So it's your obligation to put that tax aside. But here's the kicker. Most people don't lodge their tax return until May of the following year if they're lodging through a tax agent. Now, if you're lodging yourself, you've got to lodge by the end of October. But if you're lodging through a tax agent, you've got additional time, and that might not be until the 15th of May in the following year. But in the meantime, you've earned more income. And let's say you had an even better year. So let's just do this for 1 second. Let's just put in the 15th of May 2026, and then let's call this one here the 30th of June 2026. So let's say in the next year you do even better and you make $200,000. And let's say the tax on that, although it will be high because of progressive rates, but let's for argument's sake, let's call it $45,000. So when you lodge your return on the 15th of May, the tax office is going to assess that return. They'll assess that $100,000 and say that you owe $20,000 in tax. And that's going to be payable immediately. But you've also earned another $200,000 in income, right? And the ATO is going to start asking for instalments. So once you lodge that tax return, they are going to assume that you earn $100,000 in the following year. What they're then going to do is say, right, we think that you're going to make another $100,000 because they don't know otherwise. And because you lodged so late, they're actually going to ask for all the tax. So this is 2025 financial year. This relates to this $20,000 here. They're also going to ask for $20,000 that they think is for the 2026 financial year. Okay? Which is relating to this. So you've got to pay basically all in one go when you lodge your return, give or take, $40,000. Right? But you've probably, as I said, if the business is growing and you've earned, let's say, $200,000, you're still going to be $25,000 short of what you've paid to the ATO. So you need to put that aside for when you lodge the next year's tax return. So first of all, in the first year, you've got to be the one that's diligent in putting aside that tax. And that's why tax planning is important, because until you know your position, until you know how much profit you've made, you won't know how much tax you've got to pay, and you may not know how much to put aside. And if you're not putting that aside, you're going to get a real shock in that May of the following year when you lodge, because you've effectively got 2 years worth of tax to pay, and that can be the real kicker for you. This is also an issue if you're a business that's growing rapidly. If you grow from 100,000 in the first year, or you make a loss in the first year and then you make 500,000, $1 million profit in the next year, the tax office isn't going to issue those pay-as-you-go installments, so that you're not paying them any money, and you've got to be the one that's making sure you're putting aside that tax. So unless you know what's going on, it's going to be a real kicker to you. So it's really important that you do this tax planning to understand your tax position, so that you can put that tax aside and make sure you don't have a cash flow issue when it comes time to lodge your return and get those installments. Now, just to clarify, once you've lodged that first return and you get into that correct rhythm in your second and third year, every quarter the tax office will issue your company or you individually what's called a pay-as-you-go installment. And so that will be estimating the amount of tax that you need to pay to the tax office each quarter. So in that third year, you've effectively got 2 years of tax to catch up, and then you start that third year paying every quarter. So it's really important you understand your tax position, so that you're putting that money aside and not getting burnt in your second year of business. So what you can do is, on the tax office website, they've got some simple calculators. I'll link it in the description, where you can go and find out, put in your income for the year and find out what your estimated tax payable will be. Of course, we definitely advise going and seeing your accountant about this and having that discussion with them. Now, of course, none of this is possible if you don't have a good accounting system to know what your profit is going to be, to know what your sales and expenses are. And it's one of the first things you should be doing when you're setting up a business, is getting in a proper cloud accounting software, something like a Xero, so that you can not only issue invoices but keep track of all your expenses. So if you're new to business, make sure you've got a separate business bank account, so that you can track all your income and expenses. And then you can work out what your tax position is. But that's really the least important reason that you should have a good accounting software and keeping up to date with it. You need to be able to know if your jobs, what you're invoicing, is profitable or not. Tax is really the least important reason that you should be having good accounting systems and accounting records. Every month you should know what your profit and loss is, so that you can make important decisions about your business. There's no point in looking back 12 months later and seeing what you did. You really need to know, at a minimum quarterly, but ideally monthly, how the business is going. So just to round that off, your tax position is understanding what your profit is, how much tax you're going to pay, and when you're going to have to pay it. It's really valuable to understand that position first. It's the first step in tax planning. All right, now let's get into the meat of it, the tax planning and tax strategy side of things. There's one thing I really want to explain before we get started in this, and it's a question that I often got when I had my accounting practice. And that question is, should I buy XYZ? Should I buy this laptop, this car, or whatever it might be? And what I always said to people is, don't spend $1 on something you don't need just to save 30 cents. So let me explain that. I'll jump on the iPad, and I think it's best if I show this by example. Let's say, for example, you earn $100,000 in income. Now, as we know from our marginal tax rates, $100,000 puts us in the 30% tax bracket. So over the $45,000, you're going to be paying 30% in tax on every dollar, right up to $135,000. So what that means then is that every dollar you save through a deduction, what it actually does is it reduces your income by that deduction amount. Now, sometimes people think, if I buy a laptop for $1,000, and let's say it is an eligible deduction, that I'm going to get $1,000 back in tax. it doesn't work that way, and let me show you. So let's say you had a deduction of $1,000 for a laptop. What that would do is that would bring your taxable income down to $99,000, and so that's what you would pay tax on. But what hasn't changed is the percentages of the tax rate that you're paying. So you're still paying tax in that 30% bracket. So actually, the deduction of $1,000 at 30% has only saved you $300 in tax. Now, that's beneficial if you needed that laptop, but if you don't need a new laptop or you don't need a new car, then going and buying one will only save you, as in this example, 30% of whatever you pay for it. Now, if you're in the top bracket, it might be 45% plus the Medicare levy. But the point is this: if you don't need it, then don't spend that $1,000 just to get $300 back, because you might as well keep that money, put it in your pocket, invest, spend it on the kids, do something else with it, because you're only going to get 30% of it back in this particular example. And the last important thing to note before we get into these strategies is that some of these strategies are a cash flow savings, which means that they're saving you the timing of cash, and some of these are actual tax savings. So the cash flow savings might be the timing of paying the tax now or in 12 months' time, but others tax savings are absolute savings, meaning that you are saving that money right now and you're not going to just be bringing that benefit forward. And that'll make more sense as we go through these tax planning strategies. Now, as we go through these tax planning strategies, I'm going to talk about some general strategies that basically apply to all businesses, and then I'm going to talk about some specific ones that relate to companies and trusts. Probably the most common and basic strategy of tax planning is prepayments. If you're an SBE, a small business entity, it's an aggregated turnover of under $10 million, you can prepay up to 12 months worth of expenses. These might be things like insurance, rent, subscriptions, or even interest. Now, this is a really good timing strategy. It brings the expenses forward out of the next financial year into the current financial year. And so that can reduce your tax in this current financial year. But the problem with prepayments is they're like a drug, because if you bring forward prepayments from next year into this year, it means that in the next financial year, you don't have those expenses available. So next year, you also have to bring forward the prepayments of the following year. Otherwise, you're going to have a potential spike in profits because of bringing forward those prepayment expenses. Does that make sense? So it's one of those cycles that once you jump on, you kind of have to continue on. But as I'll discuss at the end, there can be a real absolute tax benefit to bringing forward expenses through the prepayments method, where you've got a discrepancy in tax rates between financial years. The next option, which is available to those who account for their income on a cash basis, is deferring income to the following year. It's kind of the opposite of prepayments, but has the same effect. So if you might normally raise an invoice in the beginning of June, and that customer would pay before the 30th of June, you could wait and raise that invoice later in the month or in July, and that customer won't pay until the next financial year, in which case that income won't be counted to you in the current financial year. For those who are on the accruals basis of accounting, and that means that you account for your income whether you've received that cash or not, it is arguable that you could delay the raising of those invoices to delay the recognition of that income. But also, on the other hand, under the true accrual method of accounting, where you've performed those services or sold those products, you've effectively earned that income, and It's arguable that delaying those raising of those invoices would defer that income, but it is something that you should talk to your accountant and tax agent about and see if that is something that's suitable for you with your accounting method. The next option relates to your inventory. First of all, you should do regular stock takes for your business. It helps you to know if you've got any leakage through theft or damage or other reasons, but you should do a stock take at or near the end of the financial year. There are some exceptions for certain small businesses, but regardless of that exception, I'd certainly recommend and advise that you do a stock take at or near the end of the financial year so that you know your true stock position. And then what that will allow you to do is you can choose each year the method of accounting for your stock, whether that be the cost method, the market, or the replacement cost method. Now the cost is what you've paid for the stock to get it to that point to your warehouse. Market valuation method, well, that's the value that you would sell the goods for in the normal market. So your recommended retail price, for example. And then the replacement cost is the cost in the market right now to replace that product, quite simple. So different valuation methods allow you to inflate or deflate the value of the closing value of stock for a particular financial year. Depending on what those different methods are, might mean that you can increase or decrease your cost of goods sold for that year, which would increase or decrease your expenses, and again, making that same change to your profit. And that can certainly be valuable. And like prepayments, it might have some value in the current year, but it's going to come back to you in the following year. Now, there may be an absolute benefit to that tax savings where you've got different marginal rates in one year compared to another, and we'll show a worked example at the end of how that actually works. But just beware, changing that closing stock value might come back to bite you in the following year. As you're looking at stock, what you can also do is look at if there's any obsolete stock that's damaged, unsaleable, past its use by date, water damaged, or for some other reason it has no value, you can't sell it anymore. You can write off that stock because its market value is basically zero. Write off that stock before the 30th of June, do it in writing, and that'll be a deduction to you in that current financial year. The next option is to look at writing off bad debts. Now, a bad debt is an amount that's owed from a customer that you can't recover. For example, the customer has gone into administration, you're not expected to recover any of that, or they've gone missing for some reason and you know you're not going to be able to recover that debt. Now, for those who account on the cash basis, this isn't an issue because you only account for that income when you receive it. And because you haven't received it, that wouldn't be counted as income in your accounts, and so you're not paying tax on it, so you don't need to worry. If you account on an accruals basis, then you will need to write off this debt, and that needs to be done in writing and in a sort of a formal process and documented, and you need to write that off before the 30th of June. That then removes that income from your accounts so that you're not paying tax on that income anymore. If for some reason that customer returns again and you do recover that debt, it will then just be added back as income in that year. All right, next is superannuation payments. Those are the payments that you make to the superannuation accounts of your employees if you have them. Generally, these payments are required to be made quarterly, and so they're usually paid in arrears. So the wages paid to your employees in April, May and June would not normally be due until the 28th of July. That means that that's deductible to you in the following financial year. Now there's a real opportunity in this year in particular because the superannuation rate goes from 11.5% this current financial year to 12% next financial year. And what that means is any superannuation that is paid into the employee's accounts next financial year, even if it might relate to this financial year, is required to be paid at 12%. So there's an opportunity to make sure that you pay the superannuation for your employees before the 30th of June. It needs to arrive in their accounts before the 30th of June so that you can pay it at the 11.5% percent rate, which is what you paid their wages on. So this is a 0.5% arbitrage, or should I say, if you don't pay it on time, it's a 0.5% penalty. Now on $25,000 of superannuation, which is quite realistic for businesses that have a number of employees, and this might be 3 months worth of superannuation. It might be April, May and June. $25,000 is going to cost you or save you $1,250 by paying it before the 30th of June. All right, we're going to work through 2 more examples, and then we're going to go to some specific strategies for different types of entities. The next one is realising a capital loss if you've made a capital gain. So capital losses can only be offset against capital gains. So let's say you've sold shares or property in this year and you've got a spike in income. You could realise the losses on some of your other assets that are in a loss-making position, and that will offset the capital gain that you've made. Now again, just a reminder, this isn't financial advice. I'm not telling you what shares or property that you should sell, but if you do have a capital gain, you can use losses from other capital assets in the same class against that capital gain. And lastly is the instant asset write-off. It's kind of like the prepayments in its effectiveness. So it allows for certain capital assets, plant and equipment, like cars, tools, laptops, furniture, under $20,000, and that's per asset, purchased in the financial year, you can write off immediately, which means you can claim the full cost of that asset as a deduction in this financial year. Again, that's really just bringing forward the expense, because normally with assets you would take a deduction, which is called depreciation, over the life of that asset, or however long you would use it, 3, 4, 5, 8 years. But it does have a cash flow benefit because you've paid that $15,000 for that car as an example, so you get the deduction for it in this year rather than having to wait and do it over a number of years. So there is a cash flow benefit to that. In terms of being a tax benefit, again, like prepayments, it's more about a timing issue than it is about a full tax deduction that's absolute. But again, as we'll show towards the end with the timing, the difference between marginal rates, it may actually be an absolute benefit to you. All right, well, that's it for the general tax planning tips that apply to business. And again, this is really just an overview. There are some more specific strategies that you should discuss with your accountant, but I want to give a broad overview and an understanding of tax planning opportunities that you can take for your business right now. So now we're going to look at some specific strategies for both trusts and companies. So starting with trusts, a really popular structure used in business, particularly smaller businesses today. It's often called a family trust, but usually it's more correctly a discretionary trust. And what that means is that the trustee has the discretion of how to apply the income and the profits and including capital gains from that trust to the different beneficiaries of the trust. There's some important paperwork that needs to be done before the 30th of June, and I hope that you already know about this. If this is your first year with a trust, hopefully the accountant that set it up for you or the lawyer has explained it, but you do need to make resolutions of how you're going to allocate that income before the 30th of June. Technically, you can do that verbally, but arguably you need to do it in writing before the 30th of June to make that effective. So I'm not going to go into the detail of that. Please see your accountant or lawyer who helped establish that structure for you, and they will tell you what you need to do. But the tax planning opportunity comes with the discretion that the trustee has in allocating that income of the trust. They can choose which beneficiaries to distribute that income to, assuming that there's no PSI or PSB issues, which is a whole nother discussion, but assuming that it's genuine profit from a business, then you will be able to allocate that to different beneficiaries. Now, if this is a mum and dad type business, then you can allocate that profit between those 2 adults if they're working in the business, and you could do that equally, which would allow a tax benefit by splitting that income between those 2 adults. Again, I don't know your situation, you need to sit down with your accountant and go through it, but there is that opportunity to vary that distribution depending on who the beneficiaries are and what their current tax positions are and their tax rates. And lastly, with trusts, one opportunity that the trustee has with that discretion of where that income or those profits go is they can allocate some of the profits of the trust, or all if they choose, to what's called a bucket company. A bucket company, like the name suggests, is another entity that trust can distribute some of those profits into. The advantage of that being is that if the trust has made large profits during the year, let's say $500,000, distributing that to both adult beneficiaries, as an example, mum and dad, would be $250,000 each. So they're going to be on the top marginal rate of 45%, over $190,000 each. So over $380,000, they're paying the top marginal tax rate. So a profit of $500,000 is going to be $120,000 that's being paid at that very top rate. If you were to distribute all of that, or let's say some of that, let's say $100,000 to that bucket company is only going to pay tax at 25%. So you've got an arbitrage there, so to speak, between the 25% of the company and the 45% the individuals receiving that income from the trust. So that's saving 20% or $20,000 on that $100,000 distribution to that bucket company. So what that means is the company will then pay the tax on that in the following year when everyone else has their tax due, but it is a lesser tax. And then you've got a timing issue or opportunity with paying dividends out of that bucket company to the shareholders at a time when they might be on a lower income, which may mean that they're paying a lower tax. So this is about possible absolute tax planning advantage by distributing to a bucket company. But again, the nuances of that are in the detail of your specific position, which needs to be discussed and explored. Next, we're going to talk specifically about companies. There's just two quick things to cover off here. One is dividends. So dividends is the payment of the profits out of a company. There are some issues that you might want to address before the 30th of June to make sure that drawings out of the company, you might want to declare them as dividends. And again, this comes to a timing issue of, do you think you're going to have a higher income this year versus next year, depending on when you might want to pay out those dividends or not, because those dividends are going to flow to the shareholders and ultimately they're going to flow through to an individual somewhere. So you need to look at the timing of those dividends. And lastly, for companies, you want to make sure that if there are loans to directors or individuals from the company, that any Division 7A issues are taken care of. Again, I'm not going to go down that rabbit hole of Division 7A, but it is something to raise and discuss with your accountant if you have a company. Now, I will just make one comment about individuals. There's going to be lots of information out there about tax planning for individuals, and I don't intend to go down that rabbit hole. But one thing I will mention, which many people do forget, is the government's superannuation co-contribution. The government will match up to $500 for certain low-income earners if they make after-tax contributions to their superannuation. And this is $500 basically for free. Obviously, it's trying to incentivise people to make contributions to their superannuation, but it is a real win if you've got someone in the family that's in that situation. So have a look at that one and see if that fits your current situation to make that contribution. All right, so what I want to do now is I want to work through a worked example to show how this will actually make some tax savings to your business. And I'm going to break this up between tax timing savings, so potentially bringing savings forward, and absolute tax savings where you've really made a tax saving and not just moved that saving around. So let's jump into an actual example. So we're going to pick just a couple of these strategies and make some assumptions and show you how it's going to work. So let's say this company is going to do a couple of things. They're going to prepay $3,000 in insurance. So let's say it's the building or the public liability insurance. Then they're going through their stock and they've worked out that $2,000 worth of their stock is obsolete, it's out of date, or it's been water damaged. So they're going to write off $2,000 of that stock. They've gone through their debtors and their bad debts and found a couple of suppliers or customers, sorry, that haven't paid and aren't going to pay, and there's about $2,500 in bad debts, so they're going to write that off. They're also going to make sure that they pay into their employees' super accounts before the 30th of June $25,000 in superannuation payable amounts that relate to the June quarter, April, May and June. And lastly, they operate the business through a trust, so they're going to distribute $50,000 of trust income to a bucket company. So firstly, the timing benefits to this tax planning situation. So the total of those savings, which is a combination of prepayments, early payments and the bucket company distribution, is $82,500. So at a marginal tax rate, the top tax rate of 45%, that's $37,125. Now, you can do your own calculation. If your marginal tax rate's 30%, then you can do the calculation based on that. All right, and so the bucket company will have to pay tax on that $50,000, and that will be at 25%, which is $12,500 tax. So if we take that $12,500 off the $37,125 of savings that we calculated before, that's a tax saving of $24,625. Now, those are basically a timing saving. And we've sort of discussed this before because next year you're not going to have those deductions because many of them you've brought forward. But where it becomes an absolute saving is when you've got a difference in the marginal rate between the current year and the following year. So let's say, for example, in the current year you have a large event, like you've made a large capital gain, or your business has had a certain spike in income that you don't expect to continue. So that would be, let's say in the current year, a 45% marginal tax rate, whereas in the following year it might only be 30%. And what that does then, and that gives us an absolute savings between having the income, the extra income, because we haven't brought forward those deductions in the current year compared to the next year. So it's really simple maths. If I had $10,000 more income in this year, and I'm on the 45% marginal rate, more than next year, which is the 30% rate, I'm saving 15% by deferring that income to the following year. And on $10,000, well, that's $1,500. So in this scenario, if we remove, for example, remember it was $82,500, if we take out that $50,000 to the bucket company, which isn't going to change year on year because it's still 25% this year and next year. So we've got $32,500 left. If this year we're on 45% and next year we're on 30%, we've been able to defer $32,500 of income to next year. At 15%, that's a saving of almost $5,000, and that's an absolute saving. This isn't about timing now. We've managed to legally move the income around so that we are taxed on it in a lower tax year. The other absolute saving that we're going to make is on the superannuation payment by making sure that's paid into the employees' accounts before the 30th of June. As I mentioned before, that's going to save $1,250 in additional superannuation that we won't have to pay, and that's an absolute tax saving too. So overall, we will have made over $6,000 in absolute or permanent tax savings by going through some of those tax planning strategies. Lastly, I want to go through some actionable items that you can do right now to make sure that you make the most of these tax planning strategies. First, speak to your accountant. If your accountant hasn't already reached out about tax planning, then you may need to look at getting a new accountant because it's a really valuable process to go through. Second, you need to make sure that you've got good accounting records. Get your accounting system up to date. If you can't do the tax planning if you don't know what your tax position is, what your profit is, and then your current tax liabilities. Once you've worked out your tax position, make sure you put that money aside. Put it in an interest-bearing account so that it's not going backwards on you, but don't let it be spent because you will have a cash flow issue if you don't have it there. And lastly, sit down with your accountant and work out which of these strategies are most helpful for you. Well, I hope you found this helpful, informative and educational so that you can go have a positive conversation with your accountant about some tax planning strategies that you can do before the 30th of June. Now, some of this related to this specific financial year ending 30 June 2025, but mostly these suggestions relate to each and every tax year. And I hope you found this helpful. If you have, I'd really appreciate it if you could like and subscribe and follow, because I'll be sharing more videos that are helpful to your business. Not just on the accounting and tax, that's going to be a very small portion. It's going to be on how you can start, grow and scale your business.